Zach, how much money do I need to start day trading or swing trading or investing? And that's a valid question. Today we're gonna go over the pros and cons of a small account and pros and cons of a big account. We need to understand those two in order to answer the question, and how to grow a small account to a big account and how to maintain a big account. Whether you're new to the game or struggling in trading or looking to refine your strategy, this video has information for everyone. So stick around, stick to the end, take notes, and let's find the account size that suits you best. Hey everyone, Zach here, and welcome to the world of investing, the channel for day trading, swing trading, and long-term investing. It is very important to know the pros and cons of a small account and a big account and know the differences between them before you jump in and make a decision. So how much is a small account and how much is a big account? In my personal opinion, anything under $25,000 is a small account. Anywhere between $25,000 to $100,000 accounts are medium accounts. Anywhere over $100,000 is a large account. I'm gonna go through the pros and cons of a small account and pros and cons in a medium and large accounts. It applies to both. So let's start with small accounts. Pro number one, small accounts tends to keep you picky on setups and stocks and trades. You don't have much to trade with, so you have to be picky and you can't afford big losses. That's why it keeps you picky. You see, you only can trade A+ setups in order to grow a small account. And if you don't trade A+ setups, you can see significant blows in your account. Pro number two, it helps you develop patience. Small accounts takes a long time to build on it to become a big account. And the chart for growing a small account looks like this. Because in a small account, you are risking 1% of your account or a small amount of your account, that means your reward is gonna be small as well, okay? That's why it takes time. Pro number three, it helps you keep your emotions in check because your risk is a very small dollar amount. So you won't have a very hard time dealing with your emotions. Let's start with the cons. Con number one, big mistakes can blow up your account. So you can have a significant losses that would actually really affect your account. So you have to be careful. So you don't have the privilege to say, oh, that's a great setup, I'm gonna risk 10% of my account. You don't have these kind of privileges. I don't think you even have it on a big account. Con number two, transaction fees can eat up your account and it can corrupt your RVR ratio, especially in accounts outside of US. A lot of brokers in US, it's zero fees on your transactions. But outside of US, most of them charge. And those charges can eat up your account and corrupt your RVR ratios. Let me give you an example. So let's say you have a $2,000 account. Risk 1% to reward 3%. So if you're risking 1%, that means you're risking $20 for the potential of making 3%, which is equal to $60 in profits. And your transactions fees from your broker are $5 per transaction in buying and selling. So if you lose $20. It is 20 plus 5 buying plus 5 selling equals $30. So instead of losing $20, you're actually losing $30. Let's talk about taking profits. If you're profitable, you make $60 minus the $5 in buying fees and minus $5 in selling fees. So your P&L shows $50. So instead of the RVR being $20 to $60, it's gonna show $30 to $50. Instead of it being 1 to 3, it's gonna actually be 1 to 1.6, I guess. And 1 to 1.6 is not a good RVR. For small accounts, they have to be 1 to 3 and above. Two things you can do to fix this. First, never go for setups that has an RVR less than 1 to 4. And that even makes you pickier on choosing your trades. And another thing you can do, which is highly suggested, I would do that. I would keep feeding my small account enough money that covers my fees that the broker takes. So if you start with a $2,000 account, it doesn't mean that you can't just keep feeding it money. You can feed it money. You can feed it a couple $100 a month or $100 a month or whatever the fees are. You can calculate them and feed them back in. Con number three, slippage in your order fill can cost you a lot of money and it can blow up your account, especially when you're using hard stop orders and the stock you are trading is very volatile. You can get stuck in a halt, and sometimes it can eat double what you anticipated to lose. And that's the problem with some brokers that provide zero commission fees. They have very bad executions. It happens a lot of lagging and slippage in their platform. Good brokers that charges commission usually have good fills in their platforms. I know institutional traders actually use Lightspeed even though they do charge fees, but their fills are great. And to avoid slippage in a small account, trade with non-volatile stocks. Don't hop on stocks that halts 5 times a day or it's halting up to the up and to the down. Just avoid those. You don't need that. You don't need to desperately trying to grow your account. They can really harm your account. I know you want stocks that are moving in order to make nice profits, and nothing wrong with that. Just avoid the stocks that actually halting. Another thing to avoid slippage, you can check the spread in the level 2 between the buyers and the sellers and make sure it's a very tight spread. Don't go with high spreads. It can also kill your small account. If you don't know what the spread is, I'll be making a video very soon about level 2 and explaining how to read level 2, and then you'll figure out what I'm talking about. Just briefly explaining what a spread is. It's the difference between the buyers that willing to buy price and the sellers that willing to sell price. So if a buyer is bidding at $10 a share, for example, and the seller is selling at $10.05. So that difference is the spread. It's 5 cents. And sometimes volatile stocks can go up to $1 or up to 80 cents or 90 cents or $2. So we gotta avoid those in small accounts. And another thing to help with decreasing the slippage hurt in your account is factoring it in your stop loss. If you buy a stock at $10 and you want to stop out and exit the trade at $9.50 if it was a losing, give it some wiggle room. Make it $9.40 instead of $9.50, and calculate that within your risk analysis and make sure it works with your RVR, risk to reward ratio. With all that being said, sometimes you can't avoid slippage, but you have to do what we said that you should be doing to decrease the chances of it happening. Because sometimes you enter a stock and it's nice, smooth, the spread is small, and then all of a sudden all the buyers hop in or all the sellers hop in at the same time, and it goes crazy while you're actually in the trade and you didn't even know it's gonna go that wild. So it's okay. Sometimes you get stuck into it, but minimize the times as much as you can. And in some cases, it can work to your advantage. Very volatile stocks, especially when they're going in your direction and you're taking profits, sometimes it executes your profits way higher than you even wanted to. You put a limit order on $11 on a $10 you bought one, and then it fills you at $11.20. And it happened to be a couple times. Not a lot, but it does happen. Con number 4, falling into the PDT rule. And that's only in the United States. It's not outside of the United States. PDT rule is falling into the pattern day trader rule. And briefly, you can only trade 3 times a week, in and out. It can work to your advantage. That way it makes you even pickier, but sometimes you can miss opportunities. And that rule goes away once your account has over $25,000. So when you start hitting the medium, it goes away. Con number 5, small accounts give a bigger chance to fall into FOMO. FOMO is fear of missing out. So you start chasing trades, chasing setups sometimes because you would say, oh, that's gonna take so long to grow my account. I really wanna be getting into more trades and more trades and more trades, and you can fall into FOMO. If you can avoid falling into FOMO, that would protect your small account and grows it even faster than falling into FOMO. So you might start chasing setups instead of waiting for the setup to come to you and for you to get in a proper entry. I'll tell you folks, FOMO was one of my biggest weaknesses when I started trading, but now it means nothing to me. I managed to get away from FOMO because I realized FOMO, it was the reason of me not being able to grow my account. Con number 6, the devil starts talking to your head, oh, it's gonna take me forever to grow this account. So you start forcing trades. Not FOMO. FOMO is chasing a trade, fear of missing out, but forcing a trade. You start want to trade because today there's no setups. Nothing actually shown that it's worth my investment, and I keep jumping onto trades that it does not even meet my criterias or my strategy. Folks, if you don't fall into FOMO and you don't force trades and you do your due diligence and proper education and planning, you can grow your small account into a big account way faster than you think. Just avoid those and you can grow them way faster. It just needs discipline. And one of the disciplines that you need to do right now, just click that like button, hit the subscribe button, and let's move on to the next point. So how do we grow a small account? Number one, avoid all the cons. Work and take advantage of all the pros. 3, be disciplined. 4, keep depositing money into your account to cover your fees and to cover the charges that the broker charges for life data. Number 5, I'm gonna mention it, but I don't recommend it to everybody, even though it makes a big difference. Once you learn how to trade options, it can grow your account even way faster. But the problem with options, you need to have an edge in the market in order to trade options. And that's why I don't recommend it to new traders until you develop an edge in the market. And then we're going to be talking a lot about options, and I'm going to be explaining a lot about options as well. So let's move on to the big accounts, 25,000 and up. Remember, big accounts is 100,000 and up, but I'm going to include the 25,000 to 200,000 with all the big account cons and pros. And let's start with pro number 1. You can make a decent living out of it if you have the proper education and training. Pro number 2, you can afford to get involved in more than one trade at a time. When I was growing small accounts, I've done it many times. Many times I've missed a swing trade here or another setup here because I was already in one trade and I couldn't use my money, enough money. I don't have enough money to get involved in another trade. So I missed on a lot of good setups because I had a small account. Big accounts, you don't have this problem anymore. Pro number 3, transaction fees, it's not a problem anymore. Let's say you're risking $1,000 on a trade for the potential to make $3,000. It's okay if it's $1,010 or it's the winner is $2,990 instead of $3,000. It does not corrupt your RVR. Now let's start with the cons. Con number 1, it can really affect your emotions. When you see big numbers are going down in the minus or in the plus, oh my God, your emotions can be really, your heart can be pumping, you can be sweating, it can affect your emotions. That's one of the cons. And one of the things that you gotta do in that, you gotta trust your setup. After you've paper traded, after you've traded with a small account, you know the setup works. You have to trust it. And especially on big accounts when you're risking $10,000 on a trade or $5,000 on a trade for the potential to make 15 and 20,000. Okay, when it gets to 4,000, it's a big number. Con number 2, I've seen it many times with other traders that I've been through their trades. They take profits prematurely, so they're risking $10,000 to make potentially $20,000 or $30,000 on that trade. Once they see the 10,000 in their pocket, they start taking profits, or 15,000. But the RVR does not work. 10,000 to 15,000, it's 1 to 1.5. It does not work. Minimum on a big account has to be 1 to 2 RVR. So you can't be taking premature profits, but your emotion starts playing a lot and your devil starts saying, oh, you have money, take profits, and it can harm your RVR. Con number 3, it can cause you to overtrade. Your devil starts talking to you, it's okay, you have money, you can trade, you can take this one, you can take this trade, you gotta be as picky as you are with a small account. You have to be very picky. With overtrading, it can affect your pre-trade plan, and you stop planning and you start, because you have a big account, you can afford to lose right now. You can afford to lose. That's how you get significant blows in your accounts. I've had people that lost $180,000 out of a $200,000 account. We had a big long discussion when we had to reset all over again. Now, it was wrong from the beginning. He didn't even have proper training. He didn't paper trade. He was just trading, okay? But see how fast his money can be in 6 months. $180,000. You gotta be careful, folks. Do not overtrade on a big account. Con number 4, you can fall into liquidity issues, and that can be a disaster. If you get stuck in a trade and you can't exit with the lack of volume, that will significantly have a big effect on your account. It can blow a big portion of your account. Especially, I'm just gonna give it just a hypothetical example. You have 10,000 shares in a stock that you bought, for example, at $10, and you wanna risk $5,000. So at $9.50 you wanna sell. You'll find a buyer that's willing to buy 500 stocks at $9.50, so he buys that, and then the second one up is at $9.40. The one after at $9.30, 500, 500, 500, or 100, and sometimes you can't even get out of the whole amount of the 10,000 shares not until you hit $8. So instead of risking $5,000, you can significantly blow like 12,000 or 15,000 on a trade. So you gotta know and be familiar with volume profile and liquidity. It's crucial and it's very important. We'll be talking a lot of videos about them and how to realize that this is a good stock with for a big account or not. Con number 5. Sometimes your fill orders does not completely fill. Sometimes you get into a trade and it only fills a quarter of your order or half of your order. So you're half a position in or a quarter position in, and there's nothing you can do about it. It happens. Not every time, it does happen here and then. So that can screw up your overall performance of your portfolio. So we have said before that your risk has to be consistent. So every trade that you're risking, it has to be 1% of your in order to make 3% of your account. And in this way, you're only risking 0.25% of your account to make 0.75% of your account or 0.5% of your account. Sometimes it does happen, but it's okay. There's nothing you can do about it. So how do you maintain a big account? First, proper education and proper training. Second, don't fall into the cons. Third, take advantage of all the pros. Fourth, stay picky and let the stock show its face. That's very important. Stay picky and have the stock to show you that it's worth your investment. And this advice, it's even applied for a small account. Just make sure you keep it serious. Not because you have a big account, you think that it's okay to lose here or there. It's not okay. Only trade grade A setups. And one more big advice for big account holders. Every month or every couple of months, take off half of your profits and actually put them into your long-term portfolio. And that's very important. Folks, if you think that I'm providing some value here, hit the thumbs up button. That'll help the channel. It'll help others find these information beneficial to them as well. So the question is how much money you should start with. My advice is contingent with 3 major factors. The first one is the proper education and the proper training. Second one, make sure you have paper traded and you prove to yourself that you are a profitable trader. Your setups work and your risk analysis work. Number 3, only trade with money you can afford to lose. Never trade with money that you think it can be used for a bill or a mortgage payment or any of that. It's money that's set aside. If you don't have that money, you can keep paper trading and improving on your technical analysis until you have enough money set aside. After you've done these, now we talk about money. If you have a small account, anywhere between $25,000 and less, I don't care if you start with any of that number. If you have a lot of cash on the side and let's say you have $30,000, $40,000, $50,000, you have $100,000 that you can start with, I strongly recommend that you put only 10% into trading and prove to yourself that you can grow that small account into a big account. So if you can't grow that small account to a big account, what makes you think that you can be profitable with a big account? Prove to yourself first. I'm not a financial advisor, but that's what I would do. If you want to know about how to switch between paper trading to real money trading, click that video here. And that's all, friends. Make sure you subscribe to the channel and we'll see you in the next video.